Greetings, welcome to our video on understanding the cash flow statement. The cash flow statement is a financial statement that shows the inflow and outflow of cash in a business during a specific period of time. It reports the cash generated or used by a company's operating, investing, and financing activities. The cash flow statement is an important tool for evaluating a company's financial health because it shows how much cash is available for reinvestment in the business, paying dividends, or servicing debt. The cash flow statement has three parts. They are operating activities, investing activities, and financing activities. Let's discuss them in detail. Number 1. Operating activities. This section of the cash flow statement reports the cash inflows and outflows from a company's primary operations. It includes transactions that are directly related to producing and delivering the company's products or services. Cash inflows from operating activities might include payments received from customers for goods or services sold, interest received from loans made to others, and dividends received from other companies in which the business has invested. Cash outflows from operating activities might include payments made to suppliers for goods or services purchased, salaries and wages paid to employees, taxes paid to governments, and interest paid on loans. 2. Investing activities. This section of the cash flow statement reports the cash inflows and outflows related to the acquisition and disposal of long-term assets, such as property, plant, and equipment. Cash inflows from investing activities might include proceeds from the sale of long-term assets, income received from investments in other companies, and loans made to others. Cash outflows from investing activities might include payments made to acquire long-term assets, investments in other companies. Number 3. Financing activities. This section of the cash flow statement reports the cash inflows and outflows related to the company's financing activities, such as issuing or repurchasing stock, issuing or repaying debt, and paying dividends. Cash inflows from financing activities might include proceeds from the issuance of debt or equity securities, contributions from owners, or loans received from banks or other lenders. Cash outflows from financing activities might include payments made to repurchase stock, repay loans or other debts, and pay dividends to shareholders. By looking at the cash flow statement and analyzing each of these sections, stakeholders can gain a better understanding of a company's cash position and cash flow trends over time. This information can help them make informed decisions about investing in or lending money to the company. If you find the video helpful, please like the video, it will be helpful for this channel. Now come to importance of cash flow statement. Here are some of the key reasons why the cash flow statement is important. Helps identify cash flow problems. The cash flow statement allows stakeholders to identify potential cash flow problems that may not be apparent on the income statement or balance sheet. For example, a company may be reporting a profit on its income statement, but it may have a negative cash flow due to delayed payments from customers or excessive spending on capital expenditures. Assists in financial planning. By analyzing the cash flow statement, companies can plan for future cash needs, such as investments in new projects or repayment of debt. Facilitates investment decisions. Investors use the cash flow statement to evaluate a company's financial health and its ability to pay dividends or reinvest in the business. Supports loan applications. Lenders use the cash flow statement to evaluate a company's ability to repay loans. A company with strong positive cash flow from operating activities is generally seen as a lower-risk borrower, while a company with negative cash flow may have difficulty obtaining financing. Provides transparency. The cash flow statement provides transparency into a company's financial activities and helps stakeholders understand how cash is being generated and used. This can increase trust and confidence in the company and improve relationships with investors, lenders, and other stakeholders. Let's discuss how to implement a cash flow statement. To implement a cash flow statement, an organization should follow these steps. Step 1. Determine the time period. Decide on the time period that the cash flow statement will cover, such as a month, quarter, or year. Step 2. Identify cash inflows. List all sources of cash inflows for the period, such as sales revenue, interest income, and proceeds from the sale of assets. Step 3. Calculate cash outflows. Identify all cash outflows for the period, including expenses such as salaries, rent, and supplies, as well as payments for capital expenditures, debt repayment, and dividends. Step 4. Categorize cash flows. Categorize cash flows into 3 main sections: operating activities, investing activities, and financing activities. I have discussed these part earlier in this video. Step 5. Prepare the statement. Prepare the cash flow statement using the information collected in the previous steps. The statement should show the beginning cash balance, the net increase or decrease in cash for the period, and the ending cash balance. Step 6. Analyze the statement. Analyze the cash flow statement to identify trends and potential problems. Step 7. Take action. Take action based on the analysis of the cash flow statement. If the company has negative cash flow, it may need to take steps to improve cash inflows, reduce cash outflows, or both. If the company has positive cash flow, it may consider investing in new projects or returning cash to shareholders through dividends or stock buybacks. If you want to read in details or download the PDF, go through the link in the description, and don't forget to subscribe to Education Leaves.